Business owners can expense their business-related automobile expense, and not just by taking the standard mileage rate. I found that some business owners are not the best about showing the documentation of how much they actually drive for work. Sometimes they just sort of guess. They'll drive to the office supply store, meet a customer, go to the post office, the bank, meet another customer, drop off items for business purposes, and that can all be written off. The rate for 2024 taxes is 67 cents per mile, but I found that many business owners don't know that they can deduct all those expenses. This applies only to business owners or those who are paid on 1099, not W-2 employees. The Tax Cuts and Jobs Act gives a nice tax break to business owners. To make this happen, you need to make your personal vehicle and take it and turn it into your business vehicle, or just buy a vehicle in the company name, which can be harder if you're trying to get a car loan. Your then former personal vehicle will be able to generate you a tax deduction up to the business use percentage of your vehicle usage. So if it's used more than 50% for business, for the actually writing off the cost of the car. So if Dr. Jenny has a car, it's worth $40,000, it's under 6,000 pounds, the weight makes a difference. She makes it her business car and she uses it 60% for business, 40% personal. She can write off up to $12,200 for 2024 on bonus depreciation for this qualifying vehicle. If the vehicle is over 6,000 pounds, like a large SUV, you can deduct up to $30,500. And it doesn't matter if you have a loan balance on the car or not. If you use the vehicle for less than 50% business, you have to use the mileage deduction though. Now the thing is, you must drive it mostly for work purposes, not just for commuting to work if you're going to write off the whole cost of the car. Some business owner clients have more than one business, so you want to make sure you track your mileage for each vehicle separately. I recommend clients use an app like MileIQ or QuickBooks, and there's 100 other ones online that make it easy. When you take a business vehicle and convert it to personal use, under the eyes of the IRS, they see you as placing that car into the business at that time. That means you can start depreciating the car and claim the associated deduction. To determine how you're going to do that, you want to use the lesser amount of the fair market value on the date of the conversion from a personal vehicle to a business use and an adjusted basis of the car. So generally you look at the Kelley Blue Book or other sales price on the date and you convert it and come up with the fair market value. It's a cool tax deduction. Keep in mind, you still get to deduct your operating costs like gas, insurance, oil changes, maintenance, repairs, car washes, car loan interest, parking, tolls, sales tax, license, registration, tires, those little pine cone air freshener things. All those things can be used to write off as a deduction. So taxpayers will want to evaluate whether to deduct the car all at once with bonus depreciation or over 5 years using maker's depreciation, then compare that to the mileage deduction. You can't switch back and forth from actual cost to mileage on the same vehicle. Once you use one, you have to stick with it. So the majority of our self-employed business owner clients are legitimately writing off, most of them $10,000 a year and more in car deductions. So it depends on how much you drive for work, your work purposes, and the value of the car. The more business miles you drive, the more of a tax deduction you'll have. So the IRS uses the miles you drive and the percentage of those miles for business use versus personal use to determine your allowable deductions. So the records and documents that are required to support auto expense in case of an audit is probably going to include your mileage record that shows every drive the taxpayer took, showing what is business and what is personal. Receipts for gas, insurance, repairs, all car-related expenses should be kept. If a new car is purchased, keep the dealer invoice as it will have the list price and the taxes and the license fees, which are also deductible. I recommend you keep every piece of paper or digital record as evidence of your deduction in a neat orderly file or in your computer in the same place in case of an audit. Your accountant will probably want to just look at the totals, but the IRS may want to see the actual source documentation in case of an audit. They'll probably also want to see your appointment book or a printout of that or your calendar to corroborate your business use. So just putting a magnetic sticker on your car doesn't make it a 100% work use vehicle. So there's another thing called a 90-day log, and that's where the taxpayer is allowed to meticulously track the mileage and expenses in the same manner as above, but you just track it for 90 days, multiply that out by 4, and then use that as your whole yearly number. So in short, business automobile use is a great thing. It's a good tax deduction, but you have to be very careful and meticulous when tracking all your documentation. Give us a like or subscribe if this was useful to you. Thanks.